Want to be sure you're getting the most out of your retirement for all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now here's Jim with this week's Dollars and Cents tip.
Today for Dollars and Cents, we're going to talk about how we calculate required minimum distributions when you're 70 and a half. Of course, 70 and a half is the age at which the IRS says you have to start taking money out of your IRAs, because the IRS has never been paid for most, if not all, of that money sitting in there. You've never paid the income tax on most of it, if not all of it. And the IRS wants to get their fair share. They want to start getting paid. You have to start paying your partner, so you have to start taking money out, and then every dollar that comes out is taxed at some amount. Usually the whole thing is taxed if you don't have any after-tax money in there. So how do they go about calculating those numbers? First off, if you're over 70 and a half and you have a traditional IRA or a SEP IRA, anything other than a Roth, you have to start taking money out. A Roth IRA, you never have to take money out of it while you, the account owner, are alive. Your beneficiaries do, but you do not. Now, if you have a retirement account at work and you're still working in that job with that same company, you do not have to take a required minimum distribution according to the IRS. However, you still have to check with your plan rules and see what your plan requires. But let's just say you're retired. That means all of your retirement accounts, except for the Roth, you have to take an RMD, a required minimum distribution, at age 70 and a half. Here's how they do that. First off, 70 and a half is a really unusual year. I don't know why they came up with a half a year, except it's the IRS. Basically, if you're born between January 1st and June 30th, the year you turn 70 and a half is also the year you turn 70. If you're born July 1st or later in the year, you'll never take a required minimum distribution as a 70-year-old, because by the time you're 70 and a half, you'll be 71 for that year. So here's what they do. They let's say that I was born on April the 18th of 1941. That means I'll be 70 and a half on October the 18th, which is in 3 days, as a matter of fact. If that's me, my first required minimum distribution is due, is for the year 2011. I can take that minimum anytime I want. I could take it January the 2nd of this year if I want. I don't have to wait till October the 18th. I can take it anytime I want. All the IRS cares about is it shows up on the distribution line on my tax return. If it's an IRA, it's on the IRA line. If it's a 401k, it's on the 401k line. They just want to see it there. Now, the first year, you can put it off as late as April the 1st of the following year. But let's say that I do that, and in March of next year, I take my required minimum. That is my RMD for the year 2011. And I'm only allowed to put that off the first year. Then by the end of 2012, I have to take an additional RMD for 2012. So next year, I would actually have to take 2 required minimums, one for 2011 and one for 2012. That could bump you into a whole new tax bracket if you have any kind of size value in your IRAs or retirement accounts. So normally, we recommend you take the required minimum the year you turn 70 and a half. The biggest exception to that rule is if you are working the year you turn 70 and a half. Let's say that I'm working this year and I retired in September. My taxable income for this year more than likely is much higher than what my required minimum distribution would be. So I'm better off putting it into next year, even though I would have to take 2 minimum distributions next year. So as a rule, I like to take it when you turn 70 and a half, but you do have to consider your other taxable income. Now, the way they calculate the minimum is for 2011, if that's the year that I have to take, I'm going to be 70 and a half, they're going to go back to December the 31st, the balance on December 31st of 2010. So they're looking at the balance of the end of the prior year. And they use that number to calculate your required minimum distribution. Now, most people listening, you're going to use what's called a uniform lifetime table. It's in publication 590 from the IRS. And it's the uniform lifetime table. And you look at what the age will be at the end of the year of your distribution. So at the end of this year, I'd be 70. I'm using the balance from the end of last year, but the end of this year I'll be 70. I divide by the divisor in that number. I divide by 27.4. That gives me my minimum distribution. Basically, you're taking out approximately 1/27th of the account. Okay. That's how they calculate the math. If you have 3 IRAs that add up to $250,000, they don't care where you take your minimum as long as you take the minimum. But you cannot use that aggregate rule, like you cannot combine your IRA and your 401k or your 403b and your 401k. You'd have to take the minimum from the 401k and the minimum from the IRA. There are probably 5-6 more things I need to talk about with required minimum distributions, but today for dollars and cents, I just wanted to give you a broad overview about how those distribution rules ultimately work.